Investment bank credit rating. Key factors for credit rating agencies. Presentation overview. Overview of credit rating agencies. A brief introduction to credit rating agencies and their importance in investment banking. Key factors of investment bank credit ratings. A discussion of the key factors that credit rating agencies use to determine an investment bank's credit rating, including financial statements, risks and mitigations, and management team and governance. Additional information to enhance credit rating. A review of additional information that investment banks can provide to enhance their credit rating, such as their business model, industry trends, and regulatory compliance. Introduction to credit rating agencies. Credit rating agencies. Credit rating agencies are independent entities that provide credit ratings to companies and organizations. These ratings help investors assess the risk associated with investing in a particular entity's debt. Credit rating process. Credit rating agencies use a variety of metrics to evaluate the creditworthiness of a company or organization. These metrics may include financial ratios, rating performance, and market position. Importance of credit ratings. Credit ratings are important for investment banks as they help them assess the risks associated with investing in a particular entity's debt. High credit ratings indicate lower risk, which can result in lower interest rates and higher demand for the entity's debt. Credit rating agencies overview. Creditworthiness evaluation. Credit rating agencies evaluate the creditworthiness of companies and organizations by analyzing their financial statements, business model, industry trends, regulatory compliance, and other factors. Standard & Poor's. Standard & Poor's is one of the three major credit rating agencies that evaluates the creditworthiness of companies and organizations. Its credit ratings and analysis are widely used by investors and financial institutions around the world. Moody's. Moody's is one of the three major credit rating agencies that evaluates the creditworthiness of companies and organizations. Its credit ratings and analysis are widely used by investors and financial institutions around the world. Fitch Ratings. Fitch Ratings is one of the three major credit rating agencies that evaluate the creditworthiness of companies and organizations. Its credit ratings and analysis are widely used by investors and financial institutions all around the world. Importance of credit ratings. Credit ratings play a crucial role in determining a company's ability to borrow money and the cost of borrowing. Higher credit ratings generally result in lower borrowing costs and improve access to capital. Key information credit rating agencies use. Financial performance. Credit rating agencies evaluate an investment bank's financial stability and performance, including its revenue, expenses, profits, and losses. Business strategy. Credit rating agencies evaluate an investment bank's business strategy, including its competitive position, market share, growth prospects, and risk management practices. Regulatory compliance. Credit rating agencies evaluate an investment bank's compliance with regulatory requirements, including its adherence to risk management standards and its ability to comply with government regulations. Financial statements. Credit rating agencies analyze a bank's financial statements to assess its financial health and ability to repay debt. They look at factors such as revenue, profitability, liquidity, and leverage, and use these metrics to assign a credit rating. Risks and mitigation strategies. Credit risk. Credit risk is the risk that a borrower may default on their debt obligations. Credit rating agencies assess the credit risk associated with an investment bank's business and evaluate the bank's strategies to mitigate those risks, such as diversification of investments and collateral requirements. Market risk. Market risk is the risk that the value of an investment may decline due to changes in market factors such as interest rates, currency exchange rates, and commodity prices. Credit ratings agencies assess the market risks associated with an investment bank's business and evaluate the bank's strategies to mitigate those risks, such as hedging and diversification. Operational risk. Operational risk is the risk of loss resulting from inadequate or failed internal processes, systems, or human error. Credit rating agencies assess the operational risks associated with an investment bank's business and evaluate the bank's strategies to mitigate those risks, such as implementing effective internal controls and disaster recovery plans. Management team and governance. Management team evaluation. Credit rating agencies evaluate the strength and experience of an investment bank's management team, including their qualifications, track record of success, and ability to lead the organization. Governance structure assessment. Credit rating agencies assess the effectiveness of an investment bank's governance structure, including its board of directors, executive team, and risk management processes. Additional information for credit rating agencies, industry and market analysis. Investment banks can provide credit rating agencies with in-depth analysis of the industry and markets in which the company operates, helping to provide a more complete picture of the company's financial health and future prospects. Management quality. Investment banks can provide credit rating agencies with analysis of the quality of the company's management, including their track record and experience. This information can help to provide insights into the company's ability to execute its business plan effectively. Business strategy. Investment banks can provide credit rating agencies with analysis of the company's business strategy, including their competitive advantages, growth opportunities, and potential risks. This information can help to provide insights into the company's long-term prospects and ability to generate revenue over time. Investment banking business model. Credit rating agencies evaluate an investment bank's business model to determine its long-term viability and stability. They look at factors such as the bank's revenue streams, client base, and competitive advantages. Industry trends and market position, market share. Credit rating agencies evaluate an investment bank's market share within the industry and assess how well it is positioned to compete and succeed. Competitive landscape. Credit rating agencies look at the competitive landscape of an investment bank, analyzing its strengths and weaknesses compared to its rivals. Growth prospects. Credit rating agencies evaluate an investment bank's growth prospects, analyzing its financial health, industry trends, and market potential. Regulatory compliance and capital adequacy. Regulatory compliance. Regulatory compliance is a key factor in credit rating agencies' evaluation of an investment bank. Compliance with regulatory requirements helps ensure the bank is operating legally and ethically, which can impact its overall rating. Capital adequacy. Capital adequacy is another key factor in credit rating agencies' evaluation of an investment bank. The agency looks at factors such as capital ratios and liquidity requirements to assess the bank's financial strength and ability to withstand adverse market conditions. Conclusion. Investment bank credit ratings are crucial for the bank's ability to borrow money and the cost of that borrowing. Credit rating agencies use various types of information to evaluate creditworthiness, including financial statements, risks and mitigations, and management team and governance. Investment banks can provide additional information to enhance their credit rating, such as their business model, industry trends, and regulatory compliance. Thank you.